Hello friends, we are all faced with one pertinent question: how much insurance cover do I need? Till the time we are not able to answer this question, we run the risk of being underinsured or overinsured. There are three approaches of estimating our insurance need: rule of thumb approach, human life value approach, and needs approach. Let's go through them one by one. Rule of thumbs approach. We have two alternative options: income rule or multiple of salary method. Second is premium as a percentage of income. In income rule, net income multiple is used to determine insurance needs. Net income implies income after deduction of personal consumption expenses of income earner. Multiple varies depending on age of a person. For below 35 years, multiple is in the range of 12 to 15. 35 to 50 years, 10 to 12. And for above 50, it is 8 to 10. In premium as a percentage of income, 6% of insured gross income plus an additional 1% for each dependent should be spent on life insurance premium. For example, if insured salary is 10 lakh and he has 3 dependents, one wife and 2 children, premium allocation should be 10 lakh into 9%, that is 90,000. This approach is simple to understand and easy to calculate, useful as a rough starting point in assessing one's insurance need. On negative side, it is very generic, does not consider needs and circumstance of each case, and does not take into account age of insured or dependent or any special need that may arise later. Moving on, we have human life value approach. It determines an estimation of person human life value, and amount of life insurance needed is calculated in multiple of earned income. It focuses on earnings of individual that would have been lost in case of premature death. Steps involved in determining human life value are: find current income of individual, deduct his personal expenses, taxes and life insurance premium, find earning life from current age, find discount factor rate, and find present value of required income stream by using inflation adjusted return. For example, if annual remuneration of a person is 10 lakh with 5% growth rate, personal expenses are rupees 2 lakh, rate of interest is 10%, and earning life is 25 years. Then first of all we will calculate discount factor rate, which is 1 plus rate of return divided by 1 plus salary growth rate, which comes out to be 4.76% in this case. After this, we will calculate present value of income stream by using Excel or financial calculator. The value comes out to be 1,32,40,757. This approach is easy to understand conceptually, although calculation involves a number of steps. Major disadvantage is estimating individual's future level of income as he or she goes through changes as career progresses. Also, assumption with respect to discount rate plays a crucial role in determining HLV. Family needs approach is based on assumption that goal of life insurance is to cover surviving family members' needs, which can be cash need, immediate need at death, net income need, ongoing family need, and special needs, lump sum needs occasioned by certain specific events like child's tertiary education or marriage. This approach is scientific since primary reason for taking life insurance is to prevent a decline in standard of living of dependent and to permit dependents to live in a manner that matches their basic lifestyle in case earner does not survive. For example, husband and dependent wife life expectancy is 40 years, discounting factor is 3%, current portfolio 20 lakhs, immediate cash need in case of death is 1 lakh, present annual expenses of wife is 2.5 lakh, special needs after 10 years is 10 lakh. Insurance is equal to immediate cash need, present value of future annual expense plus present value of special expense. The total comes out to be 67,96,148. This approach makes a lot of sense conceptually, although calculation involves a number of steps. The major disadvantage of this approach is it relies on static analysis, that is determining need of insurance at a specific point of time, but need of individual will vary depending upon his age, social status, number of dependent, and financial or physical assets. Now let's discuss few important terms related to insurance. First of all, sum insured versus sum assured. Life insurance pays sum assured and non-life insurance pays sum insured. There is a difference between similar sounding terms. Sum assured refers to benefit, sum insured is reimbursement of loss. Sum assured is a pre-decided amount that policyholder gets when insured event takes place, like in life insurance. Non-life insurance work on principle of indemnity, which offers an amount called sum insured. It provides coverage only for the losses due to any damage that happens to insured asset. There are also insurances which offer dual benefit, like critical illness plan. Next, we have surrender value and paid up value. If premium for at least 3 consecutive years are paid, there shall be a guaranteed surrender value. If policy is not surrendered, it shall subsist as a paid up policy for a reduced sum in case further premiums are not paid. Paid up value is equal to number of premium paid divided by number of premiums payable into sum assured. Next, we have riders or add-on covers. Riders are add-on or additional benefit which you can opt for along with current life insurance policy at affordable rates. Riders are valuable tools that helps in expanding life insurance coverage. Major benefits of riders are: it provides extra coverage at an affordable price, it makes your policy flexible, and whatever rider you take, you will get tax benefits for it. Popular types of riders are critical illness rider, that is financial benefit on being diagnosed with the critical illness. Disability rider, benefits on being afflicted with disability covered by rider. Accidental death benefit rider, that is benefit on accident leading to death. Term rider offers monthly income to nominee on death of life assured. Waiver of premium rider, policyholder not required to pay future premium on the policy in the event on accident or mishap as defined by the rider. Next term is deductible. Deductible or excess is the portion of any claim that is not covered by insurance provider, normally quoted as a fixed quantity and is part of most policies covering losses to policyholder. Like in car insurance, a deductible will apply to claim arising from damage to car. A franchise is similar to deductible, so in that insurer makes no settlement if claim is below franchise figure. Co-payment means insured is made to bear certain percentage of claim amount and balance is only paid by insurance. Let's differentiate between them with the help of following table. For example, deductible amount is 50,000 in the case of excess and claim is 60,000, then claim payable is only 10,000. In case of franchisee, for example, deductible amount is 70,000 and claim made is of 65,000, then no claim will be payable. For franchise, if deductible amount is 70,000 and claim is 80,000, then full claim of 80,000 will be payable. Lastly, for co-payment, if deductible amount is of 20% and claim is 60%, then the insurance company will pay only 80% of the claim, that is 48,000. Let's go through certain miscellaneous terms. First, co-insurance. Co-insurance means same property can be insured with multiple insurer. Whenever loss occur, it is reimbursed by all reinsurers proportionately. Next is exclusions. Policy provision that eliminates coverage for some type of risk. Insurer utilizes exclusion to carve away coverage of risk they are not willing to take. Next is days of grace. Extra time given for payment of premium after due date, normally a period of 15 days to 1 month. Policy loan paid by insurer against surrender value accrued to a policy. It adds marketability to insurance product. This wraps up our discussion on life insurance. We will discuss health insurance in our next video. Thank you.